Our main focus today will be on the Markowitz mean variance portfolio optimization. For our discussion, I'll be referencing the Finance ResearchGate website. However, before we dive into that, let's first thoroughly discuss the mathematical foundations of this theory. The basic concept of mean variance portfolio optimization is very simple. Our methodology heavily relies upon the variance-covariance matrix, and we also depend significantly on the mean return. Subsequently, if we multiply the inverse of that variance matrix by the mean return, we then obtain a value known as Z, which ultimately provides us with the appropriate weight. It's important to note that a higher Z value consistently corresponds to a higher weight.
To demonstrate the mathematics behind how this works, let us apply the logic to a scenario involving a two-asset case.
And the very first scenario we're going to explore involves absolutely no covariance between these factors. What this fundamentally means is that they are operating completely independently of one another. Consequently, there's no statistical correlation or any shared covariance whatsoever in their respective rates of return.
Oh, the first parameter that we're looking at, pause what we're dealing with here, is the return matrix. Yeah, pause. I'm going to say that I'm referring to. Yeah, pause. Well, not just columns, but more precisely, a column vector.
The first asset you see has a mean return of just 0.5%. The second one, in stark contrast, offers a significantly higher average rate of return coming in at 2%. So if you take into account the average expected return, we are going to put all of our money into the second asset for the simple reason that it offers a significantly higher rate of return overall. Furthermore, if you take a look at the covariance matrix, you will see that in this specific instance, the variance of the second asset, which is the one providing a much higher expected return, also carries with it a significantly higher level of risk and a much greater degree of variance overall as well. And what this truly means is that we absolutely must diversify and carefully spread the entire weight of our financial investment across these two distinct assets.
So, in this particular instance, if we take the calculated mean and multiply it directly with the variance-covariance matrix, we will be able to successfully obtain the specific Z value that we are looking for in this calculation.
So, for instance, if we were to determine the inverse matrix at this specific location, we would then obtain a value of 25 for the primary asset and a value of 11.11 for the secondary asset. The reason that we obtained a higher number for the first asset is because it has a lower variance. This is compensated for by assigning higher weight to it within the Z matrix. At the same time, we also find that the final product is calculated along with the expected return. So, if its return is quite low, then the overall product of its inverse variance, when multiplied by its return, will ultimately determine the exact amount of that asset that will be taken. In this specific instance, the Z value for this particular asset is 0.125, but for the second asset, that value is notably higher. The way this is calculated is quite straightforward. It's simply a proportion of the individual Z value divided by the total sum of all Z values. For example, with our first asset, we found its proportion to be 36%, and for the second asset, the resulting proportion was 46%. So, even though the second asset exhibited a higher degree of variance, it was ultimately assigned a greater weight, primarily because the disparity in its returns significantly surpassed the disparity observed in its variance. Now, let's look at the second case scenario where we have a positive covariance, which means that the variables are correlated. In this situation, the two assets are positively correlated with each other. So when the price of one asset goes up, the return on the other asset will also go up and vice versa. This means that they are both moving in the exact same direction. Now, once again, the fundamental idea here is quite simple. We then take the inverse of the variance-covariance matrix and then we multiply that result by the actual return. This is precisely how we determine the value of Z. Therefore, in this specific scenario, we will obtain this particular form. And now, I want you to pay close attention to this. For the first asset in question, we're going to be rewarding it with a significantly higher weight. And this is primarily because the second asset's overall variance is demonstrably much higher. So, when the second asset's variance is higher, we invest more in the first asset, which has lower variance. Simultaneously, we must consider the product, specifically the multiplication of that with the return. This calculation will then determine the final overall Z score. It's important to note that we are now introducing an additional term which directly reflects the concept of covariance. So, what does that really mean for us? It implies we're missing a significant opportunity if we put more of our investment into the first asset, since the second asset's rate of return moves in the same direction. So, by investing more weight here, we are losing the opportunity of earning the 2% return of the second asset. Since positive covariance exists, we're losing the chance to gain from the second asset's return. This will eventually lower the Z score for the first asset. Similarly, when looking at the second asset, we need to consider its individual variance, particularly as it relates to the variance of the initial asset. So in this case, less weight will be assigned to the second asset, given that the variance of the first asset, which is 4% here, is significantly lower. Therefore, the second asset will receive a lower weighting despite the fact that it has a higher rate of return. The product will determine the overall Z value along with the covariance term. In this scenario, we are foregoing the opportunity associated with the initial asset. However, this particular opportunity is considerably smaller given that the first asset's rate of return is quite low. So ultimately, we're going to arrive at a weight concentration that is significantly more extreme than what was observed in the first scenario. Why is this the case? It's simply due to the fact that we have a positive covariance, and consequently, we are losing the crucial opportunity for hedging. If we decide to invest a greater portion of our capital into the second asset, we are sure to achieve much greater gains and accumulate more profits, mainly because the first asset's rate of return is quite minimal. And if you invest more in the first asset, we are going to lose a lot from not investing in the second asset, given the second asset's rate of return is higher. And then the third case with negative covariance, offers more diversification and hedging opportunity. Now, when the first asset's rate of return starts to climb, the second asset's rate of return will then decline. So at this point, we are going to receive a good reward for investing a greater portion in the first asset. For example, in this specific case, if the reward would actually be quite positive, this is because if the rate of return on our first asset increases, we successfully avoid the significant loss that would otherwise occur from holding the second asset, and that potential loss is indeed very substantial. So if we were to multiply the covariance of these assets with the second asset's rate of return, that would actually be quite beneficial for us. It's a win because we successfully avoided making an investment in that second asset, especially considering the negative covariance. Consequently, this implies that we will allocate a greater proportion or more weight to the first asset. Turning our attention to the second asset, we are carefully considering the variance of this other asset. Given that its variance is quite small, this indicates we should invest a reduced amount in this particular asset. Simultaneously, however, we intend to assign a greater weight to the second asset due to the presence of its negative covariance. But still, the avoided losses from the first asset are small, so the gain for the second asset isn't the same as in the first two cases. So we anticipate that eventually more emphasis will be placed on the first asset. And this is precisely the situation where we end up investing a greater proportion in that initial asset. Consequently, the covariance factor plays a very significant role in how we determine that allocation. It's important to remember that portfolio optimization is essentially about determining the weight invested in every single asset. So if you change the weight just a little bit, even a tiny bit for any asset, then we are going to have a completely new portfolio formed. And each individual portfolio should possess its own distinct return and risk characteristics. So to effectively apply this particular concept, we'll be making use of the resources available through the Finance Research Gate. Within that environment, I'm planning to access and work with the relevant time series datasets, and for our specific analysis, I'll then proceed to select the monthly frequency option. I'll begin by selecting the starting year, which I'll set to 2000, and then I'll choose the ending year as 2024. This covers a total span of 24 years. Let's provide a bit more time to develop the functional sample. At this stage, within the time series analysis, we are taking all of the individual observations and collapsing them into a single time series variable for our work. However, in this particular instance, we are constructing a portfolio, so we'll be focusing on just a few companies to clearly demonstrate the overall idea. This means we have a very large sample of firms from which we can easily select. So, looking here at Series A, allow me to choose a specific firm, and for this particular example, we are able to search for it by using the ticker symbol. However, before we do that, we must first choose the correct variable. Naturally, for our purposes today, we are going to choose the stock return. And once we have successfully selected the appropriate variable, then we can proceed to choose the specific firms that we wish to include. For this demonstration, allow me to select just one single firm from the entire Series A. I'm going to perform a search for a specific entity, like Coca-Cola. Its official stock market ticker symbol is designated as KO. So, once I've completed my search for the stock ticker, I'll proceed to press enter, and then I'll just give it a few seconds to load. After that, within the drop-down menu, it will then present any ticker that includes both a K and an O. So, I've successfully located it right here, and perfect, we've managed to find the first company.
And then we go ahead and apply the filters.
And in this particular situation, we only chose a single company. All right, I've decided to rename the series. It's now called KO Return, which, of course, stands for Coca-Cola Return. Click anywhere outside of the box, and I will rename the variable for you.
Or the asset involved in this case.
Right now, We also have the opportunity to establish a Series B round. We can choose to partner with an entirely different investment firm this time.
You just have to give it a little time.
Alright, so we're going to proceed by selecting the monthly return data specifically for the stock. But in this particular step, we're going to make a deliberate choice to select a completely different asset. The main objective here is to precisely replicate the two-asset investment case that we thoroughly explained and went over earlier in our discussion. Let's go ahead and open up the ticker search function. We need to search for the company ExxonMobil. The ticker symbol for that particular company, I believe, is XOM. Go ahead and press the enter key right now to start the search process, and then we are going to look for the item inside of this specific box right here. There we go. We have finally managed to find it now.
And then we go ahead and apply all the filters.
Once we have successfully applied the necessary filters, we can then proceed to rename the series variable, assigning it the name ExxonMobil, which is also known by its ticker symbol XOM, and then finally return. And you'll need to press outside the box so we can rename the variable. Okay, for Series C, we're going to build a portfolio that contains both of those assets, and then we'll run a comparison to see how each asset performs relative to the other. First, enable Series C and proceed so we can compare risk-adjusted returns and see which holding drove performance.
And then it's essential that we maintain this particular section in an open and accessible state. Now, please take careful note that in the preceding steps, we had already successfully obtained the mean value.
The mean here is irrelevant if you're only considering a single firm. This is because the very definition of a mean requires you to calculate an average value across multiple firms. Consequently, with just one firm, you cannot compute an average. You simply have one observation. Therefore, it becomes quite meaningless if you were to select only a single firm for analysis. However, in the specific case of Series C, if I am choosing to pick more than one firm, it implies that my objective is to calculate the combined monthly return across those two selected firms for every single month. So, ultimately, we will have just one observation for every single period. For our analysis, please select the same specific variable, the monthly return. And then our next step will be to conduct a thorough search for those two specific companies. I'll initiate this process by focusing our attention on Coca-Cola first. Give it some time. So for now, we're going to limit the number of tickers we're analyzing to just KO. And then once that's complete, we should definitely be able to find it. Additionally, please search for
ExxonMobil stock.
You can press enter now.
we should probably give it a little bit more time to process. And then after that, we will certainly be able to find it quite easily. The specific company we are searching for is XOM. So having successfully selected these two particular firms, we can now confidently proceed to the next step in our process. Our next action will be to apply all of the necessary filters. So in this specific instance, our objective is to determine the average monthly return for both of these firms, month by month. This is what we'd consider the most basic simple weighting approach. However, this isn't the key variable we're ultimately looking for from Series C, but it's the essential starting point we absolutely need to begin with. After that, we'll then move on to incorporate the portfolio option, KO, and we have the option to rename the series
Variable.
Please just give it a brief moment or two to settle down. And then, once we are fully ready, we are going to go ahead and apply the entire portfolio to the account exactly as we planned. So we're going to have to search for
The mean variance method.
Give it a little time. All right, so here we clearly have our primary objective laid out before us. You'll notice that we are presented with a variety of different options. Our task is to simply proceed and select the mean variance from these choices. For demonstration purposes, let's go ahead and choose this particular one. The L2 regularization technique implies that we are able to precisely define certain crucial hyperparameters, for instance, the gamma value,
which is essentially risk avoidance.
All right, so let's go ahead and choose a very simple covariance matrix.
Now, let us select, for instance, a period of 36 months for our estimation process. In this scenario, we are going to construct a portfolio many different times using a rolling window methodology because we have a long duration of data. Therefore, we are not simply going to have a single portfolio formed for every individual period in the sequence.
We are going to be doing that in a rolling window fashion.
Because we've chosen two firms that are actively involved in trading, we anticipate no issues with missing data points, meaning there's no need for us to take any action. All right, for the moment, our primary focus will be exclusively on the long position. Therefore, we are explicitly not permitting any form of short selling. And this, of course, means that we absolutely cannot have a negative weight. Considering the maximum weight allowed for each individual asset, if your goal is to effectively avoid any significant concentration of weight, then we must allow the mean variance optimization model to function entirely without any restrictions. So we will assign it its full potential, for example, a very high value. So if the portfolio optimization process suggests that we should invest much more heavily or even go fully into a single asset, then we should definitely go ahead and allow that specific outcome to happen.
The maximum number of assets to include is not really viable here because we only have 2 assets. We are already covering those 2 assets.
And for the maximum period, we're simply choosing to use months as our unit of measurement. This means our current selection is considerably higher than the absolute minimum required. Therefore, we can now proceed to run the portfolio.
See, here we have so far 3 portfolios, and now we have
the portfolio, the last one that I created. Up until this point, we have 4 different data series. Now, I will plot the individual returns that we have calculated for every one of these assets. Coca-Cola, ExxonMobil, and finally, the concept of a portfolio. The fundamental idea behind creating a portfolio is to strategically manage investments to achieve either superior return performance, effectively mitigate and lower overall risk, or ideally, to strike a beneficial balance combining both of these objectives. Give it some time to get reflected here.
So it's important to note here that the red line that you're observing here, that particular indicator, should accurately reflect the monthly financial returns from the stock investments within this specific portfolio.
Let's look at our method. Now, the red line on this chart indicates our portfolio's expected rate of return. It's important to note that it surprisingly demonstrates a significantly lower risk profile than even the most aggressively risky assets available. It's quite challenging to determine if the portfolio genuinely exhibits superior performance compared to any of these individual assets. Therefore, we can now examine this table. So, I'm going to disregard the simple weighting and also the average weighting approach, and instead, I will be focusing my attention on the mean variance portfolio, the one that has been optimized. Notice that here, if you observe, the average monthly return, specifically the monthly figure, is 0.75%. Well, this particular value is actually quite a bit higher than what we consider the lowest asset return. And in fact, it even surpasses the other asset, which was previously deemed the higher performing asset. Consequently, the portfolio optimization strategy successfully achieved a significantly higher rate of return for the entire investment portfolio. And remarkably, the associated risk level is now considerably lower. So, portfolio optimization gives us the ability to get higher returns while also lowering risk, which will greatly benefit our investments. But it's important to note that in this instance, we relied on just 2 assets. Typically, our preference is to depend on a greater number of assets, allowing us to fully capitalize on improved diversification opportunities. That concludes our discussion for today. Thank you very much for listening.